So thanks a lot for the opportunity to present. This paper here is about corporate bond factors, and it's joint work with Feldhutter, Lasse, Heje, Pedersen, and Stolborg. So what we know is that across many different fields of science, we have seen replication crises. So there's one in medicine, psychology, and so on. And before we get into it, let me try to define what we mean by a replication crisis. So you can think about two different types of replication. So last year, Mark presented a paper on corporate bonds at this conference here. And if I follow that paper step by step, I should be able to get the exact same numbers as stated in that paper. That would be pure replication. And that's not necessarily what we are concerned about when we talk about a replication crisis. So what we are concerned about is scientific replication. So what if I repeat an experiment over and over again? Do I get the same outcome? And in finance, you can think about what if we do out-of-sample testing? What if I do some robustness tests? Do the results still hold up? And if they don't, then we might have a replication crisis. And of course, while it's interesting to talk about medicine and psychology, the most interesting field in the world is, of course, finance. So what about finance? Do we also have replication crises within finance? And as you may know, there has been a heated debate in the equity factor literature. So on one side, you have Cam Harvey saying that there is a replication crisis. All this factor zoo in the equity literature, it's not robust. Results don't hold up. And on the other hand, we have these newer papers, Chen and Zimmerman, and Jensen, Kelly, and Pedersen saying that there is no replication crisis here for equity factors. And actually, surprisingly many factors can be replicated and are robust. And since Andrew and Brian are here and Lasse is a co-author on this paper I'm presenting, let's say that there is a consensus in this literature that there is no replication crisis for equity factors. But what about for corporate bond factors then? Well, there we have this very interesting and recent paper by Dick-Nielsen, Müller, and Robotti, saying that the results in this other paper by Bai, Barley, and Wen does not hold up. The results are not robust. And this paper by Bai, Barley, Wen, well, that is a corporate bond factor paper. And what they say in that paper is that, well, we find that this downside risk factor is significant and priced in the corporate bond market. And now we know that that result is not robust. So the question we are looking for here in our paper is this just a single incident, or do we have a broader replication crisis in this literature for corporate bonds? So do we have a replication crisis or not? And a related question is then, if we do have a replication crisis, then where do we stand after that? Do we have any factors left, or are we back to a simple CAPM for corporate bonds? A very simple factor model. And that is what they find up in the Dick-Nielsen paper, that it's very difficult to actually be beating the CAPM for corporate bonds. And the same argument also goes back to Farmer Friends, saying that for corporate bonds, we should expect a very simple factor model, a CAPM time model, to hold true. So that's the two questions we're looking for here. So at this point in time, you should be speculating, so if there's no replication crisis in the equity literature, then why should there be one in the corporate bond literature? So what's the difference between these two different types of instruments or fields or whatever you want to say? What is it that makes corporate bonds special? And the thing is that there is no CRISP for corporate bonds. So what do you do in the equity market? You come up with a great new signal, you go to CRISP, you test if it's priced in the factor returns there. So there is this common data set that we are all using in the equity literature. And someone has gone over this data manually and checked for outliers and errors and so on. So we have a common data set we're all using, which is clean and to a large extent also error-free. And that's not the case in the corporate bond literature. So there the usual approach is to start with the trace data. And trace data, that is corporate bond transactions. And then you have to end up somewhere with a t-stat above 2 for your factor return later on. And in between these two extremes, you have the transaction data. You need to get a t-stat above 2. Well, there you have to make a million different choices in between these two things here. And what we show in this paper and what we argue is that, of course, these choices, they have a meaningful impact on the outcome in the end. And we suggest a common framework for this. How do we overcome this? So what are the modeling choices you need to be concerned about when we talk about corporate bonds? Well, you have to define what kind of sample are you using, what bonds to include, how do you calculate a price, how do you calculate a return, Once you have returns, what do you do then about outliers? Do you winterize, delete them, keep them, and so on? And for all of these questions, there's no consensus in the literature. There's not one standard way of doing it. And I will show you in a minute that this severely impacts what you get out in the end. Another way, or another concern in this literature is that there's no standard factor construction methodology as well. So different papers do different things. Should you do equally weighting, value weighting? Do you do some kind of single sorting on your signal? Do you double sorting? Do you do 5 portfolios, 10 portfolios, whatever? You see it all within the literature here. And this also severely impacts the outcome in the end, as I will also show you in a minute. So what we suggest here in this paper is to come up with a new framework and say, let's get closer to having a CRISP for corporate bonds. So we manually check outliers in the data set and decide whether they are true returns or actually errors. And once we have this, or something which is close to CRISP for corporate bonds, then we also suggest a robust factor construction methodology, and we're going to focus on the alphas of these factors we're going to test later on against a very simple benchmark model. And finally, we're going to construct these factors both on a bond level and on a firm level. So what does that mean? Well, in the corporate bond literature, when you have corporate bonds, usually each firm have very many corporate bonds outstanding. So for the same firm at one point in time, you will have many different time series. You have one time series per bond outstanding, essentially. But we can also try to collapse all of these into just one return per firm and say, this is the corporate bond return for this firm here. And this opens up a new range of possibilities and a lot of new signals we can also include. And that's also what we're going to do here in this paper. So now that we have the new framework, hopefully a robust framework as well. So going back to the research questions, do we see a replication crisis for corporate bond factors? And then the answer is, yes, we do. And this graph here illustrates the replication crisis that we identify. So the percentage terms here I have on each bar, that's the replication rate, essentially. So I test for a wide range of different factors, which have been found to be significant in literature, and how many of them are still significant when I apply this new framework to the same factor. And we have different conditions we can do it under here. I can use only the trace data. Then I have a time period from 2002 and up till today. Then I can do the bond level or the firm level returns. And there I get this replication rate of around 23%. I can also try to use some other data than the trace data. So going back in time, I can use the Varga-Lehman database and the Merrill Lynch ICE database based on quotes. And then I get this data set from 1988 up to 2002. I still have a very low replication rate. I can merge these data samples. I can also do multiple testing adjustments, which is not standard currently in the literature for corporate bonds here. And no matter which number you pick up here, we will say that there is a replication crisis. The replication rate is fairly low. So does this mean that we are left with the CAPM for corporate bond? Well, it doesn't mean that. You can still see I can actually replicate some of the factors out there. And I'm also going to show you later on that I can introduce a range of new factors where many of these new factors are in fact also significant. So there are very many significant factors, but there's also a replication crisis. So in the end, we do reject this CAPM for corporate bonds as well. So that's the main result I'm going to show you here, and that's what to look out for in the presentation. So this is the outline of the rest of the talk here. I'm going to tell you about this new framework. What is it actually we are suggesting as a common framework for these factor constructions? Once we have this in place, we can look at the replication rates on the bond level. I can tell you about the firm level returns and what to do there. And finally, I will introduce a range of new equity market signals and show that many of these are in fact significant in explaining corporate bond returns. So this is what we're going to do. So the first thing up is the framework. And I said there's no CRISP for corporate bonds. So what's the issue here? What are the transaction errors that we have to look out for? And let me show you two examples which illustrate the pitfalls here we have to look out for. This is one example, a United Airline bond. And here I have transactions from Trace around September 2004. I have the date of the transaction, the timestamp, and then you can see the price out here. And when we calculate returns later on, I'm going to use the price at the very last trading day of the month. In this case here, it would be the 28th. And clearly up here, even if I hadn't made this red bracket up here, you should be able to see that there is one clear outlier up here. So this bond is recorded with a transaction price of $7,575, and there's no way that anyone paid that amount of money for this bond. So that is a clear error. If I left it in, as some papers do, we just say, let's leave all of these outliers in, well then you would get a monthly return of 4,500%. That's a huge return. That's of course not correct. Other papers, they would winterize the data, so we would take this return of 4,500% and we would yank it down to around 30% maybe. But that would still be wrong. And we could also delete it, which in this case here would probably be the right thing to do because we don't know what was the actual transaction price on that day. What's the fair level? We can maybe speculate, but we don't know exactly what it would be. Another extreme example here is for General Motors. This is a corporate bond issued by their financing arm. And here we look at the pricing around December 2008 when General Motors got saved or rescued. And you can see these two different numbers up here in the red bracket. That's before they get rescued. The bond trades around $20. Then they get rescued, and the bond jumps up to $45. And if you owned the bond in this period, you would get the return of 125%. And that is also a very big return. And if you just do what they do in literature currently and say, we're going to delete all returns above maybe 30%, you would be deleting this return here, and that would not be correct. Here you should keep it in. And again, winterizing here is also not the best way. You would maybe take the 125 and yank it down to 30%. So we cannot just make these simple rules. We would like to have a data set as crisp where we manually inspect these outliers and then keep the true returns and delete the errors. So how do we get closer to having this crisp for corporate bonds? Well, the first thing to do is to check the trace data. In the trace data, some transactions are already marked as errors, and of course we have to delete them, so that's the first step. The next thing to do is to calculate a daily volume-weighted price. That's also fairly standard. And when we calculate monthly returns, we are using the end of the month price. And if there is no price on the end of the month, then we go one trading day back and use that price. If there's no there, we go one more day back with a maximum of 5 days. And that is sort of standard in literature as well to do this. You might also be wondering what's the alternative to this approach. Well, some papers actually say if there is a missing price at the end of the month, I'm going to do interpolation and get the price at this missing month here. And that is always possibly, I guess, if you do that, you are bound to find some kind of momentum in the end. But that is also a possibility, of course. So once we have this, then we take out the 5,000 largest returns in absolute sense, and we inspect them manually. So each of these observations are then checked independently by 2 RAs. If they agree that this is an error or not, well, then we record it as that. And if they disagree, then a third person, one of us authors here, will then inspect the return and decide whether it's an error or not. And when we do this, I mean, you can see from before that some of these observations are clear outliers. Other things you can do is to look at other bonds from the same issuers. Do all the bonds jump up in price as they do for the General Motors? Then it's probably not an error. You can also look what happens in the market. You can look at firm-specific news and so on. So you can actually get to the bottom of this to a very large extent and see whether this is an error or not. So we delete these errors, but equally important, we keep all the observations that are not errors, even if the return is very high, as in the General Motors case before. And as part of this cleaning, we also see that for specific bond types, well, they are prone to have errors because it's difficult, apparently, to report in these bonds. And specifically, we remove equity-linked bonds from the sample on account of this. So this is, in essence, what we do. So now we are closer to having this crisp for corporate bonds. Does it matter? Does it have an impact? And it does have an impact. Let me try to illustrate it up here. So we select 4 highly cited papers in this literature, the corporate bond literature. Each of these papers argue in favor of a specific bond factor. You have a momentum factor, the downside risk or value at risk factor, a liquidity beta, and a VIX beta down here. And of course, in these papers, these factors are all significant, or else I guess they wouldn't be published. So if you look at the momentum graph up in the top left corner, that's from the Jostova et al. Paper published in the RFS. The blue bar up here, that's the point estimate plus minus 2 times the standard deviation as reported in the paper. So here we have a monthly excess return, which is positive and significant as it should be. Then I can do pure replication. Let me try to follow exactly what is done in that paper and get the same result. And that's the orange bar up here. And for the momentum paper, it works out so that I do get a positive estimate, point estimate, and it's also significant. So that's good. Now what happens if I switch the cleaning methodology that they're doing in that paper to my new framework as I suggest here? Then I get the green bar up here. And suddenly you get a different result. The point estimate flips signs, it becomes insignificant. Each of these 4 papers have their own way of cleaning data. So I can also take a cleaning methodology from one of the other papers and set in. And that's the gray bars up here. And you see the same result that, well, when I switch around the cleaning methodologies, the result is not robust anymore. And that's the same thing for the other papers there. It's also difficult for me to do pure replication, but the takeaway is still the same, that the cleaning methodology has a meaningful impact. And if you start to switch around the cleaning methodology, well then it seems like many of these factors are no longer robust. The other thing that we are arguing is also an important issue is this factor construction methodology. So we suggest to do like this here, which to a large extent mirror what they do in Brian's replication paper from the equity market as well. So first up, it's fairly straightforward to argue that corporate bonds are probably affected by the level of credit risk that is for the firm. So if credit risk is systematic, then if you're more credit risky, you will also have a higher expected return. And we don't want a new signal, which is just a new pseudo-sorting on credit risk, essentially. So the first thing we do here is to sort into different buckets of credit risk. So we have an IG plus, investment grade plus, IG minus, which is essentially BBB bonds, and then we have spec grade bonds. And then within each of these 3 groups, we then do dependent sorts, where we sort into terciles based on the relevant signal that we're looking at. And then within each of these buckets here, we do long-short portfolios. So I get a long-short portfolio for each of these rating groups. I can study them on their own, but we also do the thing in the bottom here that we just take the average return across these 3 different rating buckets. And this will be our factor construction. So we are using a big deal of the data when we are doing this terciles instead of deciles or something like that. So does this also have a meaningful impact on the result in the end? And if I look at the same 4 papers from before, the momentum paper, value at risk, liquidity beta, and VIX beta, here what I do now is I'm going to fix the data set. I'm going to use our data, the manually cleaned data, but now I'm going to vary the factor construction as what is done in these papers here. And the purple bars up here, well, that's our way of doing it, and the other ones, that's for the other papers. So what we get here is that approximately the same point estimate across the different methodologies, but in favor of our methodology is that you get lower standard deviations, so a higher precision, if you want it in that way. So again, we argue that this is a robust way of doing it, so let's do it in this way. Okay, so now we have the framework in place. Let's try to see if replication holds up with this new framework. So let's do bond level factors. So we're going to use our clean data set. We're going to use this new factor construction methodology. And we're going to benchmark against this very simple Farmer-French model from '93. So I have a credit market factor, which is just the return on the credit, the excess return on the credit market. These are interest rate instruments, so there's probably also some interest rate risk in there. Let's try to control that for that with a term factor. So these are the 2 factors we have in there. And then we calculate the alpha, and if the alpha is significant, then we will say that this factor is indeed also significant. So what does it look like? So here I take 26 different factors from the literature, and I test if they are significant within our new framework. So in the top panel, I have monthly excess returns for the factor. In the bottom panel, I have this alpha, and this is the one that we're going to be looking at. So you can see very many of these factors do not replicate. So this is the 23% that I had initially. That's the replication rate. Some factors, they do replicate. And I mean, we can read them up here. That's the credit spread, short-term reversal, equity momentum, book to price, so Mark's factor from last year. We also have duration and bond age. So these are the 6 factors in this specification here, which can be replicated. And the others, we don't get them to be significant with our new methodology. Let's try also to do a sort of an out-of-sample test. So this was only using trace data. What if I also try to use some other data source, which some papers also do in literature? So this is where, let me now take the Varga-Lehmann data and the Merrill Lynch ICE data and construct an out-of-sample test. So most of these factors has been tested on the trace data. So when I use this new data set, that is sort of an out-of-sample test, even if it is at a time period which is at the other side of this year. So this is from 1988 to 2002. And that's what I call the early sample up in the top here. And I can also combine them, and then I have the merged sample. And the conclusion is very much the same as before, that the replication rate is very low. I do get some other results now. It's not the same factors necessarily. Now I also get that, for example, Supra's long-term reversal factor is significant here when I extend the sample and get a longer time series. But some of the factors are also there from before, bond age, equity momentum, and so on. So there are robust factors, but there are also a range of factors which do not hold up when we do this new framework. And I can do even more robustness tests, of course, and we do that in the paper, and the conclusion is still the same, that replication rates are low. I can try to lag signals even more. I can look at the liquid universe of bonds. Maybe this is about stale pricing and so on. Or I can do some pure credit returns where I hedge out the interest rate risk. And in each of these cases here, I get a low replication rate. And when I lag the signal, the short-term reversal factor is also killed off. So that's probably driven by maybe a bid-ask bounce in the end. Okay, so that was the bond level factors. Let me try to do the firm level factors instead. So what is it about firm level factors? Well, if I have one equity return, then I can easily match it if I also just have one corporate bond return and say, this is the corporate bond return for that firm. And then I can naturally sort of link from the equity market to the bond market. I can even be using the same signals as Pharma French is doing, and also as Supra has a paper which is doing that. So what we do is just to take the value-weighted monthly returns across the different bonds outstanding for one firm, and then we combine it into one return. And there we have to do something. What if the returns are missing for some of the bonds? Well, then we have to do some duration adjustments, and we describe that in the paper. So what's the good thing about having this other type of return as well? Well, now we have this single time series per firm, so we're not overrepresenting any firms just on the basis that they have many different corporate bonds outstanding. That's going to affect my sorting if they have a lot of bonds outstanding. Now when I sort, at least each bond is sort of matched up against each other. And maybe I can also start to separate signals into, is this a signal which works on the bond level, so a per bond signal, or is this more like a firm level signal? So that could also be interesting to look at. So let's repeat the same exercise as before, try to replicate these 26 factors from before, but now with this new firm level return instead. And here we can see that the replication rate is still extremely low. If you look at the bottom panel here, that's the alphas, and there are not very many alphas here which are significant. I do have the equity momentum still, but there are also some new factors here, for example, amount outstanding and market value here. So amount outstanding is interesting because that is something like the size of the aggregate, the total corporate bond issuance by the firm, which suddenly matters. So liquidity didn't really matter for the individual bond, but on an aggregate firm level, it seems to be priced at least. And finally, let me try to look at the equity market signals. And this is going to be the last thing for today here. So now that I have these firm level returns, let me try to introduce a lot of equity market signals. So a whole new range of signals. This has been done previously in Subra's paper. He looks at 10 different equity signals. So I'm going to use the signals from Brian's paper here and extend that to 150 different equity factors. So I take this factor zoo from the equity market and I see if it can predict corporate bond returns. And here I don't list, of course, in the bottom panel you see these factors one by one. I don't list all the names, but you can see the blue bars over here. That's when you get positive and significant alpha. So they predict in the same way as for the equity market. The green bars over there, well, that's also significant, but with a negative sign, meaning that that's the opposite sign as what you would expect from the equity market. And you can imagine that this could be about, for example, risk shifting. If the factor is measuring risk shifting, that's good news for the equity side, but it's bad news for the bond side. And that's when you get these things down here. If you want to get some idea about which factors do we actually look at here, we can then aggregate these factors up to some groups where they are based on their correlation, and we get this equity momentum is still highly significant. We have the investment factor, we have some debt issuance, and in the other end you have the value and the short-term reversal factor. So this is saying that, well, we do have a replication crisis, as I argued before, but there are still very many factors out there which are indeed significant in explaining corporate bond returns. So if I sum up here, the conclusion is we identify here in this paper that there is a need for a new framework here. Right now, each paper is using their own data cleaning methodology, their own factor construction methodology, and this severely impacts the results. So we suggest this new framework. We try to create this CRISP for corporate bonds where we manually look at the outliers. And once we have this framework in place, we can see that many of the factors out there do not replicate, and we have this replication crisis. So they are simply not robust to what we do here. But we are still left with, there are some factors at the bond level which are significant. There are also factors at the firm level which are significant. There is a wide range of factors which can still explain corporate bond returns, so we also end up rejecting the CAPM as the dominant model. So thanks a lot for your attention, and I'm looking forward to the discussion.